Do you want $50,000 in 6 months? Or do you want to build $485,000 in assets over 30 years? Do you want to know the fastest route to financial freedom through real estate? The answer is simple. Clarify your goal. Decide your time frame. Why does this matter? This slide explains everything. There are 2 strategies in real estate investing. Fix and flip. Target big profits in the short term, $50,000 in 6 months. Buy and hold. Build assets over the long term. Loan paid off in 30 years, $485,000 in assets. But here's the fundamental difference. Flip is a transaction, heavily business-oriented. If you stop working, your income stops. Hold is more like asset management. Your assets keep working for you. However, operational management is required. Those who don't understand this difference will work forever. Those who do will build a life where assets work for them. Today, I'll show you the mathematical proof. First, look at the fix and flip numbers. Purchase price, $150,000. Renovation cost, $40,000. Total investment, $190,000. Sell this for $240,000 after 6 months. Gross profit, $50,000. But here's what matters. There are 4 risk factors. First, renovation cost overruns. Planned at $40,000, but overruns are common. Hidden issues are discovered. Permits get delayed. Material costs rise. Property condition and material prices fluctuate, so you need to budget for contingencies on the safe side. Second, sales delays. There's no guarantee you'll sell in 6 months. If the market cools, it could take a year. Especially now with high interest rates, just a few months. Delay in selling creates the highest risk ever that most of your profit disappears in interest payments. Hard money lender rates can exceed 10 to 12%. Third, market decline. U.S. national indices have historically seen peak-to-trough drops of around 25%. Some regions saw declines exceeding 30%. If the market drops after purchase, you face losses. Fourth, short-term capital gains tax. Sales within 1 year are short-term capital gains, taxed at ordinary income tax rates. Depending on your income tax bracket, high earners can face over 37% federal tax alone. Plus, state taxes and additional levies can increase the burden. Even with $50,000 in profit, your tax liability varies by income bracket, state taxes, and deductions. Short-term gains are typically taxed as ordinary income, making them less favorable than long-term. This is the reality of flip. Now the buy and hold numbers. Purchase price, $200,000. Down payment, $40,000, remaining $160,000, financed with a 30-year fixed-rate loan. Monthly rental income, $1,800. Loan payment, property tax, insurance, management fees, and repairs total $1,400. Monthly cash flow, $400. But here's the caveat. In a high-rate environment since 2022, monthly cash flow can easily turn negative on the same property depending on loan terms. 30-year fixed rates in 2024-2025 are approximately 6.5 to 7.0%. In today's high-rate environment, you need to increase your down payment or find undervalued properties. But assuming you can keep expenses at $1,400, you're left with $400 per month. Recalculate with the latest rates, insurance, and tax data before purchasing. $4,800 per year. This amount increases as rent rises. The cumulative total over 30 years becomes even larger. But here's where compound magic works. After 30 years, the loan is paid off. Assuming property value increases at 3% annually, $200,000 becomes approximately $485,000. This is your asset. And rent increases 1 to 3% annually. Inflation hedge. Meanwhile, principal and interest payments remain fixed. Even as rent and taxes rise with inflation, the major portion of your loan payment doesn't change, and your real burden keeps decreasing. However, operating expenses like property taxes and insurance can rise with inflation. Insurance premium spikes are also a risk factor in recent years. You need to factor in cost increases from climate change. Time becomes your ally. This is the power of hold. Look at the cumulative cash flow effect. This is a scenario accounting for rent increases. First 10 years, $400 per month. $48,000 over 120 months. Years 11 to 20, rent rises to $500 per month. $60,000 over 120 months. Years 21 to 30, $600 per month. $72,000 over 120 months. Total, $180,000. But here's the real return. After 30 years, the loan is paid off. With no loan payment, your net income increases, but operating expenses like property tax, insurance, management, and repairs continue. Still, most of the $1,800 monthly rent goes into your pocket. A foundation of approximately $21,600 annually. Your assets work for you, even when you don't. Retire at 65, and income keeps coming. 75, 85, 95 years old. As long as you live, income continues. This is the power of compounding. Time transforms small cash flows into massive assets. Patience generates the greatest returns. Let's compare the risks. Flip has 4 high risks. Renovation cost overruns, sales delays, market decline, and short-term capital gains tax. All of these are external factors difficult for you to control. Especially now with high rates, if sales are delayed, profit evaporates into interest payments. Furthermore, the lock-in effect creates inventory shortages, increasing flip difficulty. Many homeowners won't let go of low-rate mortgages, putting existing home inventory at historic lows. If the market drops, you can't avoid losses. Hold, on the other hand, has 4 risks: vacancy, repairs, tenant issues, and recent insurance premium spikes. But these are manageable. Vacancy rates vary by region and phase, so set them using public statistics and submarket performance for your target area. Repair and replacement costs vary significantly by property. Estimate annual maintenance and future replacements from age and equipment schedules. Tenant problems can be mitigated through rigorous screening. Credit scores, proof of income, past rental history. Insurance premiums rose over 20% in many states during 2023-2024. Climate change risk has made insurance itself difficult to obtain in some regions. Factor this in as well. And your greatest weapon is diversification. Don't depend on one property. Own 3, 5, 10 properties. If one is vacant but others are filled, cash flow remains stable. This is systematized risk management. Flip is gambling, hold is strategy. However, ease of selling varies greatly by market phase. When transactions thin, flip exits become difficult, while rent and vacancy also show wider regional disparities. Tax differences determine your ultimate wealth. With flip, sales within 1 year are short-term capital gains, taxed at ordinary income tax rates. Depending on your income tax bracket, high earners can face over 37% federal tax alone. Add state taxes and additional levies, and the burden increases further. Even with $50,000 in profit, your tax liability varies by income bracket, state taxes, and deductions. Short-term is typically taxed as ordinary income, making it less favorable than long-term. With hold, if you sell after holding for over a year, it's long-term capital gains, with rates of 0%, 15%, or 20% depending on income. Additional taxes and state taxes may apply depending on conditions, but it's more favorable than short-term. Furthermore, hold has the weapon of depreciation. You can depreciate the building's value over 27.5 years. For a $200,000 property, $150,000 in building value can be expensed at $5, $455 annually. This reduces taxable income. Depreciation can potentially lower taxable income, but it depends on your personal income situation. Furthermore, upon sale, depreciation recapture tax can occur. You need to factor this into your calculations. This is the power of tax strategy. Taxes are wealth's greatest enemy. Only those who understand can legally minimize taxes. So which should you choose? The answer depends on your goals and time frame. Situations where you should choose flip You can participate in real estate full-time. You have renovation skills and connections. You can read market movements. And you need cash in the short term. For example, you want to build a down payment for the next property. Situations where you should choose hold. You have a long-term perspective. You can diversify across multiple properties. You can systematize management. And you're targeting passive income. But what's the optimal solution? Combine both. Hybrid strategy. Use the $50,000 profit from flip as down payments for hold properties. You can purchase two $200,000 properties. This generates $800 in monthly cash flow. Use that cash flow to finance the next flip. Flip generates cash, hold builds assets. This is the strategy of the wealthy. Don't stick to one strategy. Choose the optimal combination based on the situation. Now let's organize today's key points. Here's today's summary. First, the power and limits of flip. Phenomenal returns of $50,000 in 6 months. However, short-term capital gains are taxed at ordinary income rates, with high earners facing over 37%, plus state taxes increase the burden further. Risks of cost overruns, sales delays, and market declines always exist. Especially now with high rates, just a few months, delay in selling causes profit to evaporate into interest. Lock-in effect creates inventory shortages. Flip difficulty is at an all-time high. Flip is a transaction, heavily business-oriented. If you stop working, your income stops. Second, holds compound effect. Small cash flow of $400 per month accelerates with rent increases, totaling $180,000 over 30 years. And after 30 years, the loan is paid off, and you own a property worth $485,000. After payoff, with no loan payment, you have a foundation of approximately $21,600 annually in passive income. However, operating expenses like property tax, insurance, management, and repairs continue. Insurance premium spikes are also a risk factor in recent years. In the high-rate environment since 2022, you need to recalculate with the latest rate, insurance, and tax data before purchasing. This is the reward for those who make time their ally. Hold is more asset management oriented. However, operational management is required, and outsourcing to a management company brings it closer to pure investing. Third, the synergy of hybrid strategy. Use flip profits as down payments for hold properties. Use hold cash flow to finance the next flip. This cycle accelerates wealth. Rather than sticking to one strategy, choose the optimal combination based on the situation. This is how the wealthy think. Which will you choose? Short-term cash or long-term assets? Or will you design a strategy to capture both? Share your real estate investment strategy in the comments. Your goals, your market, your experience. All of it becomes wisdom for this community. Thanks for investing your time with me today. This channel breaks down the numbers on real estate investing, the power of compounding, and concrete strategies for financial freedom. Both flips short-term returns and holds long-term asset building become your weapons. If you want to gain that confidence, hit subscribe. Turn on notifications too. See you in the next one.